Hey guys, how's it going, and thanks for coming. I'm Nick and this is Real Life Money. If you like topics like this, like money, investing, and savings, don't forget to subscribe and hit that bell. So in this video, we're going over and talking about student loans and how to help you save money, pay them off even faster than you could imagine. $38,390 is the average student loan debt in America right now. Well, no, actually, that was in June of 2018, so it's definitely higher right now, probably closer, if not above, $40,000. Which also means like half people are above that mark. Some people are even into the six figures. So this is a topic worth talking about. And we're going to be going into some ways to help you save money. First, starting off with maybe look into, and of course, this video we're going just into at least checking out what you have. Understanding the amounts that you have, your interest rates, and if consolidating, which is number one we're going to be talking about, makes sense for you. Now, I do understand that sometimes you cannot consolidate your loans. Maybe they're from different companies or businesses, so you just can't merge them together. There is a company called SoFi. I am doing a little bit more research into them, but you know, there's them as well as other companies that you might be able to consolidate or refinance with, which is another thing that we want to talk about. So the first thing you really want to look into, of course, is what you even have. Look at your interest rates. Why you should look into your interest rates is because there are two factors to your loans: your principal payment and your interest payment. Very simple, whether you know that or not, but that's why they're taking longer than expected to get paid off, because you're not just paying your principal, you're just not knocking that down, you're paying interest, which is why they could be taking, I don't know, a few 5 or 10 years longer than you're expecting. And this is where I really want to focus this video around, is looking at your interest rate, because there are two types: a variable and a fixed interest rate. And no one really talks about this. It's like, oh, interest rates, they go up maybe, they go down maybe, that's about it. Well, let me give you some examples. And this is important because let's relate back to 2008. Not many people, especially my age, you might have lived through it, maybe through like school, but you might have not been affected by it. Your parents might have. But what really happened, not really relating to interest rates, let's say, but what could happen is what happened then, they only made like interest payments, and then after a few years, then the principal kicked in, so their payments were double or triple the amount that they were expecting. So you don't want this happening to you, which is going into variable rates. Variable means it goes up and down. Well, compared to what? Well, it does depend on, maybe it might be related to LIBOR, prime rate, or federal funds rate. Whether you understand that stuff at all doesn't matter. So let's say interest rates go up. That means your variable rate goes up, which means your payments go up as well, because you have more interest to pay as well as your principal. This is why it's so important, and I want to focus on it, because we are at all-time low interest rates right now. Now, whether that's going to continue for a little while, whether the Fed is suppressing them for whatever reason, not going into that. However, understand that they're probably not going to stay at all-time lows forever. Not to say it's going to change tomorrow, but understanding what we have could possibly prevent problems in the future. So giving you another example of what are interest rates, who cares? Well, one example is, let's talk about what happened with banks recently. Because now you realize that interest rates kind of matter, because if they change, then that directly affects you and your payments. Because if you're struggling to make payments now, what if your payments increase? Then that's a problem. So I want to give you an example with what happened with banks recently. You might have heard, no, you probably haven't heard about it because no one talks about it. But what banks do, they lend to each other overnight for, they have to have more cash for operation reasons. It happens all the time. So normally they lend to each other for around 2%. Well, recently, that interest rate jumped to 10% interest rate versus a 2% interest rate. That is a 250% increase, which happened overnight. So if that doesn't frighten, I'm keeping it PG, if that doesn't scare your butt off of you, I don't know what will, because if that makes your payments maybe, double, that's an issue. So if their interest rates could jump like that in a day, what could other interest rates do? So that's why we should at least know what we have. Know the actual interest rate, like know if you have 5%, know if you have 10%, or anything in between, and if you have variable or fixed. And what fixed is, very simply, is that it's just fixed. If it's 5%, it's going to be 5% forever. So if you do decide, I don't want to deal with jumping around interest rates, maybe you want to refinance into kind of locking in these lower rates and staying with a fixed rate, especially if you're going to have this loan for quite a bit, then you kind of want to have steady payments. By the way, fun fact, why these people might, and when I say these people, these companies that are providing student loans, they might sell you on the variable interest rate because a lot of the times it's actually a lower number than the fixed. So like an example, let's say a fixed rate might be 4.5%, just making up numbers, 4.5% for fixed. Variable is 3.75%. So why would you go with the fixed? Well, now you know what variable could do, and that's why you might want to go toward the fixed versus the variable, because that variable could jump to above a fixed rate. So please, 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 you don't even have to do anything. You don't have to change anything. You don't have to consolidate. You don't have to refinance. You don't have to whatever. At least check out what you have. Check your balances. Understand how much you owe. Understand your interest rates and understand your payments. Don't just hide our heads in the sand like a lot of people do. Actually be aware of what you have. So that could save you some money down the road, but let's talk about what could seriously pay your loans off even quicker than you even imagine. So we all probably understand, hey, I have a bunch of loans, I want to make some payments on them. And many people pick the minimum payments, obviously, because it's the minimum. You don't want to pay any extra to them, and you just deal with that. The problem is why it's going to take you 20 plus years or to the end of time to pay these guys off is because we're only paying the minimums. So to save the most amount of money possible is paying more than the minimum right now. And it might not make sense because why would I pay more now when I could pay less? That's because we're only thinking of the monthly payments. You could be paying less, but it's taking much longer. Versus if you're paying more, you could probably bang it out in, depends how much more, but you could bang it out in a couple years, 5 years, even 10 years, which is still quicker than, expected 20, 30 year payoff. And I also love thinking about it this way, because I have an investor's mindset, right? So let me tell you something. What are you getting on your savings account? Less than 1%, maybe 1%, maybe 2%, maybe? If you're with Ally or whatever, they're actually dropping rates recently. But let's say you want to pay an extra $100 to your student loans, right? Why should I do that when you could put in a savings account? Well, you do have to pay interest on your loans, right? So let's make it a simple number. Let's say your interest rate is 5%. If you pay an extra $100 on your loan, you no longer have to pay that interest on that, correct? Which is 5%. So if you're paying more, you're technically investing that extra money for whatever that interest rate is. So for example, if we're investing $100, we're actually gaining a 5% return guaranteed, because you no longer have to pay that interest rate. How are savings accounts looking now? So, just something to think about, guys. You can pay it off not only quicker, but you do save a lot of money in the process. So just some things to think about. Not only to maybe consolidate, everyone is different, maybe to refinance because maybe your interest rate is pretty high, and to pay off your loans as quick as possible. It's a huge problem right now. Did you know the total is $1.6 trillion in student loans? I'd say that's an issue that apparently people are starting to talk about it. All of a sudden it's a problem. It's been a problem, and we got to do something about it. And if you're going to wait around for the government to help you, yeah, I'm going there. Sorry, it's probably going to take a while. I'd rather do it on your own. Wouldn't you rather want to live your life how you want to, instead of being like a slave for 10, 20, 30 years under these loans? That's really up to you. So guys, if you have any questions, comments, or concerns, please leave them down below. I'd love to hear what you guys have to say. What do you think of student loans out there? If you have your student loans, I'd love to know what your interest rates are. I'm trying to look around what the average is, what people are actually paying. So if you know what you're paying, let other people know too. See what way is best. Where could you get the lowest interest rate so we could all help each other out. So thank you so much for watching, guys. Really appreciate it. And I'll see you in the next one.